The system of collecting and processing transaction data and communicating financial information to decision makers is known as the Accounting Information System. To use an accounting information system, you need to know which economic events to recognize. We call economic events that require recording in the financial records accounting transactions. Transaction analysis identifies how a transaction impacts the accounting equation. Here, we summarize the decision process used to decide whether or not to record economic events. In order to analyze the transactions of Sierra Corporation, we will expand the basic accounting equation as shown here. This will allow us to better illustrate the impact of transactions on stockholders' equity. To illustrate how economic events affect the expanded accounting equation, we will examine some of the events affecting Sierra Corporation during its first month. Event 1 Solution. Event 2. Event 2 Solution. If you wish to review transaction analysis for Sierra Corporation's other events during its first month of operations, go through the Accounting Cycle tutorial. Here is a summary of the transactions for Sierra Corporation during its first month of operations. This illustration demonstrates 3 important points. 1. Each transaction is analyzed in terms of its effect on assets, liabilities, and stockholders' equity. 2. The two sides of the equation must always be equal. 3. The cause of each change in stockholders' equity must be identified. An account is an individual accounting record of increases and decreases in a specific asset, liability, or stockholders' equity item. A company will have separate accounts for such items as cash, salaries expense, accounts payable, and so on. The term debit means left and credit means right, respectively. The act of entering an amount on the left side of an account is called debiting the account, and making an entry on the right side is crediting the account. When the debit amounts exceed the credits, an account has a debit balance. When the reverse is true, the account has a credit balance. The recording of debits and credits in an account can be tracked in a tabular summary or account form. Both methods are shown here. Here is an example of debiting an account. Here is an example of crediting an account. Here is an example of an account with a debit balance. The effects that debits and credits have on common stock are shown here. Common stock is increased by credits and decreased by debits with a normal credit balance. Retained earnings is increased by credits and decreased by debits with a normal credit balance. The effects that debits and credits have on revenues and expenses is shown here. Revenues normally show credit balances, while expenses show debit balances. Recall from Chapter 1 that dividends, revenues, and expenses are eventually transferred to retained earnings at the end of a reporting period. As a result, a change in any one of these 3 items affects stockholders' equity. Each transaction must affect 2 or more accounts to keep this equation in balance. Accountants use a double entry system to maintain this balance as transactions are recorded. The effects that debits and credits have on assets and liabilities are shown here. Every account classification has a normal balance, whether it is a debit or credit. For that particular account, the opposite side entries should never exceed the normal balance. The normal balance of an account is on the side where the increase in the account is recorded. Assets normally show debit balances and liabilities show credit balances. The basic accounting equation can be expanded to show the accounts that comprise stockholders' equity. This expansion and the effects of debits and credits are shown here. Transactions are initially recorded in chronological order in a journal before being transferred to the accounts. Every company has a general journal. The journal makes several significant contributions to the recording process. It discloses in one place the complete effect of a transaction. It provides a chronological record of transactions. It helps to prevent or locate errors because the debit and credit amounts for each entry can be readily compared. Entering transaction data in the journal is known as journalizing. Separate journal entries are made for each transaction. A complete entry consists of the date of the transaction, the accounts and amounts to be debited and credited, and a brief explanation of the transaction. The first 2 transactions of Sierra Corporation that were presented in Chapter 1 will be used to show the technique of journalizing. The debit account title is entered at the extreme left margin of the account titles and explanation column. The credit account title is indented on the next line. The amounts for the debits are recorded in the debit column, and the amounts for the credits are recorded in the credit column. A brief explanation of the transaction is given. The entire group of accounts maintained by a company is called the ledger. A general ledger contains all the assets, liabilities, and stockholders' equity accounts. Information in the ledger provides management with the balances in various accounts. Accounts in the general ledger are listed in the chart of accounts. Transferring journal entries to the ledger accounts is called posting. Posting accumulates the effects of journalized transactions into individual accounts. A trial balance is a list of accounts and their balances at a given time. A trial balance is limited in that it will balance and therefore not uncover errors when a transaction is not journalized, a correct journal entry is not posted, a journal entry is posted twice, incorrect accounts are used in journalizing and posting, or offsetting errors are made in recording the amount of a transaction. Here is an example of a trial balance.